The market just broke to all-time highs. And while that headline is playing on every financial news channel right now, the people who are most affected by it are not celebrating. They are panicking in ways the public cannot see. They are making phone calls to prime brokers at banks. They are staring at position sheets that are moving against them by the millions of dollars per hour. And they are doing the one thing that large, sophisticated money is never supposed to do, which is losing control of the situation in a market that is doing the exact opposite of what they were paid to predict. Today is Sunday, April 19th, 2026. As of the market close on Friday, April 18th, the S&P 500 closed above 7,000 for the first time since its all-time intraday high of 7,002.28 set on January 28th of this year. The VIX, the market's fear gauge, closed at 17.48, down 2.56% on the day, and down dramatically from its panic peak during the worst of the Iran war market dislocations in early March. Since March 30th, 2026, the S&P 500 has added nearly $6 trillion in market capitalization. $6 trillion in roughly 3 weeks. And in those same 3 weeks, hedge fund short exposure to United States equity ETFs went from the highest level since May 2025 to lower than 97% of all readings over the last 5 years. Not lower than 50%, lower than 97%. In 5 trading days. That is not a market correction. That is a controlled demolition of one side of the most crowded institutional trade in the market. The Goldman Sachs Prime brokerage desk reported that the short squeeze that began when the Iran ceasefire was announced on April 8th was the largest single-day covering of ETF short positions since August 2020, the third largest in a decade. They said it was a 5.2 sigma event compared to the past 5 years. For those who do not follow statistical language, a 5 sigma event is something that is supposed to happen approximately once in every 3.5 million trading days. Hedge fund managers who had been told by their risk departments, their macro strategists, and their research teams that going short the American equity market was the correct trade, heading into a war with Iran, are now sitting in the rubble of that bet, watching the market not just recover, but surpass every level at which they were told to add to those shorts. By the end of this video, you're going to understand exactly what the pain trade is and why it is just beginning rather than ending at this level. Why the Goldman Sachs data on systematic fund positioning shows that trend-following computer programs called CTAs have barely started buying despite the move that has already happened. Why the options market structure that was suppressing this rally for weeks has now flipped in a way that means dealers are forced to buy into every up move rather than sell into it. Why the specific pattern that is forming in the S&P 500 right now has historically preceded not just further gains, but the fastest and most violent portion of those gains. Why the 10 days following tax season represent one of the most reliable windows of forced institutional buying in the entire market calendar. Why corporate share repurchases are on pace for a record $1.1 trillion in 2026, and why the buyback window that closed during earnings season is about to reopen. And why the same sophisticated voices that told institutional clients to stay short are now doing something very specific with their language that is designed to keep retail investors out of the very trade that is going to hurt them the most to miss. Let us start with the concept of a pain trade because this is the most important phrase in markets and the most misunderstood. A pain trade is not simply a trade that goes against your position. A pain trade is a directional move in a market that has the specific characteristic of inflicting maximum financial damage on the largest number of participants simultaneously. It is the move that nobody positioned for. It is the move that the institutional consensus bet against. And it is the move that, once it begins, accelerates rather than decelerates because the very act of unwinding losing positions adds fuel to the direction that is already burning these participants. In the context of the current market, the pain trade is up. And the reason it is up is precisely because the people who are in pain are being squeezed from a short position. The Kobisi letter documented this on social media this week with a data point that should have been front-page financial news. In just 5 trading days, hedge fund short exposure to United States ETFs went from the highest level since May 2025 to lower than 97% of all historical cases over the prior 5 years. That is a historic repositioning. That is not gradual rotation. That is institutional money being forced out of short positions by a market that moved faster and further than their risk models predicted. And every dollar of short covering is a dollar of buying that does not come from conviction. It does not come from a fundamental change in view. It comes from pain. It comes from margin calls. It comes from performance benchmarks being breached. And it produces price action that looks, from the outside, like a market being driven by optimism when it is actually being driven by damage control. Now understand the second layer of this, which is the one that the Goldman CTA data from this week exposes in the clearest possible terms. Systematic trend-following funds, which manage trillions of dollars and operate by crossing price threshold triggers rather than by making fundamental judgments about the economy, had been net short American equities through most of March 2026. Goldman estimated that their positioning in U.S. equities sat at the 31st percentile of all historical exposure readings. The 31st percentile means they have 70% of their typical range of buying still to deploy. 70%. And the trigger that causes them to deploy it is not a business cycle indicator or an earnings report or a geopolitical outcome. The trigger is a price level. When the S&P 500 crosses their threshold trigger level to the upside, they are programmed to go from net short to net long and to keep adding as the price continues higher. Goldman estimated this week that CTA buying in equities alone is tracking approximately $45 billion of programmatic purchasing into the current window. $45 billion of machine buying that is not based on whether you believe the Iran ceasefire will hold, not based on whether you think the Federal Reserve will cut rates this year, not based on whether you think the economy is heading into recession or expansion, based purely on whether the price of the S&P 500 is above or below a line in the sand that a computer program drew before any of the current geopolitical situation even existed. And critically, the Benzinga analysis drawing on Goldman data this week confirmed that these funds are currently at only the 31st percentile of their typical exposure range. They have not bought anything close to their maximum allocation. They have barely started. And as the price continues higher, the programs are designed to keep adding. The higher it goes, the more they buy. The more they buy, the higher it goes. This is the mechanical, self-reinforcing loop that is the specific engine of a pain trade. The hedge funds are short and getting squeezed out of those shorts, adding buying pressure as they cover. The CTA funds are crossing threshold triggers and deploying programmatic buying that adds upward price pressure. The upward price pressure causes more CTA threshold triggers to be crossed, which causes more programmatic buying. And the entire system is amplified by the third mechanical force, which is the gamma flip in the options market. Here is what a gamma flip is and why it matters for understanding what happens next. When large investors are buying put options on the S&P 500 to hedge against downside risk, market makers who sell them those puts are in what the industry calls short gamma. In short gamma, dealers are forced to sell the underlying index when it falls to maintain their hedges and to buy it when it rises, which means they are amplifying every move in both directions. In long gamma, the opposite dynamic applies. When the market fell sharply in late February and March 2026, during the early weeks of the Iran conflict, put buying exploded. Every institutional portfolio manager who did not want to be caught without downside protection ran to the options market. The VIX spiked. Dealer gamma went deeply negative, and every down move was amplified by dealers selling into the decline to maintain their delta neutrality. This is why the market felt so disorderly during that period. It was not just selling from fundamental investors. It was a mechanical feedback loop where the very act of falling caused more falling. That dynamic has now reversed with a specific momentum that was captured in the Gamma report from April 13th, published by Kurt Altrichter, who tracks this market structure specifically. He documented that Gamma flipped positive for the first time in 8 weeks as of that report. The S&P 500 closed at 6,817, sitting 63 points inside positive Gamma territory at 6,783. Now, the entire dealer hedging dynamic that was amplifying down moves is pointing in the opposite direction. When the market goes up, dealers are now forced to buy. When it goes down, dealers are now forced to sell less aggressively. The structure that made every down move feel like a waterfall has been replaced by a structure that turns every up move into an accelerant. And the Bloomberg data from this week confirm that traders are reviving short volatility bets in a major way as peace hopes calm markets. The short volatility trade is the specific bet that the VIX stays low. When enough people pile into that bet, it becomes self-reinforcing because the selling of volatility instruments directly suppresses the VIX, which encourages more risk-taking, which drives stocks higher, which suppresses the VIX further. The Goldman analysis of this week's Goldman data by Neil Sethi, published in Benzinga, drew the most direct conclusion about what this combination of forces means. Dealer gamma, which in the first quarter acted as a ceiling forcing dealers to sell into rallies, has now moved below the market. In effect, the same hedging dynamics that capped upside earlier in the year are now positioned to amplify it. If stocks move lower, dealer rebalancing attracts buying. If they move higher, dealers may be forced to chase further. That logic helps explain why the current bid can persist longer than skeptics expect. Now let us add the fundamental dimension that most analysts covering this story are missing entirely, which is the timing dimension of where we are in the institutional money calendar. Tax day in the United States was April 15th, 2026. For individual investors, tax day represents the annual reminder to fund retirement accounts, to roll over any pending contributions, and to put capital to work in investment accounts that may have been cash-heavy during the uncertainty of the first quarter. 10 days after tax day, historically, the market experiences a consistent and measurable inflow as those contributions and rollovers are deployed into equity markets. This is not a theory. It is documented institutional calendar behavior that creates a predictable demand window that begins approximately now and runs through the end of April. And it creates demand that does not care about the VIX level, the Iran ceasefire status, or what the Federal Reserve said last week. It creates demand because the capital is available and the behavioral pattern of deploying it after tax season is deeply embedded in American investment culture. On top of this calendar effect sits the single largest structural buyer in the American equity market, which is corporate share repurchase programs. During earnings season, which began in the second week of April and runs through early May, companies are prohibited from buying back their own stock under blackout rules that prevent repurchases in the weeks around earnings announcements. That blackout window is about to end, and when it ends, a historically large volume of corporate demand is scheduled to re-enter the market. EBC Financial Group data confirmed that S&P 500 companies are on track to spend a record $1.1 trillion on share repurchases in 2026, not individually large amounts. Collectively, a constant machine bid that absorbs selling and creates a floor under the market, regardless of what geopolitical news is happening. $1.1 trillion. That is the corporate bid returning to the market in the next 2 to 3 weeks simultaneously, with the tax season deployment capital and the CTA programmatic buying. 3 separate mechanical demand streams with no fundamental common cause converging on the same time window. There's a fourth dimension to this setup that the institutional shorts most deeply misunderstood, which is the bond volatility correlation. The MOVE index measures volatility in the bond market the same way the VIX measures volatility in the equity market. Throughout the worst of the first quarter, MOVE and VIX were both elevated and highly correlated as uncertainty about the Federal Reserve's path, the Iran war energy shock, and the direction of interest rates all compressed simultaneously. What happened in the first 2 weeks of April is that MOVE began to fall as ceasefire optimism reduced energy price, uncertainty, and as the Federal Reserve made increasingly clear through New York, Fed President John Williams and others, that it was not prepared to raise rates into a war-damaged economy that was already showing GDP growth of only 0.7% in the previous quarter. When MOVE falls, the VIX follows. When the VIX follows, risk-taking accelerates. And when risk-taking accelerates in an environment where systematic funds are in the 31st percentile of their typical equity exposure, the fuel for a continued move higher is not abstract. It is countable in dollars. Now understand why the people who are on the wrong side of this are telling you not to buy it. Goldman Sachs, in a note from its trading desk this week, said that if there is only 2 to 2.5% additional upside remaining in the index, there is limited reason to allocate aggressively. The Goldman most shorted stocks basket jumped 13% in a single week, outperforming the broader S&P 500 by 9 percentage points, according to Bloomberg, its best week since 2023. The same Goldman Prime brokerage desk is simultaneously telling institutional clients there is limited upside, while the Goldman CTA data is showing that systematic funds have 70% of their normal buying capacity still to deploy. Both things cannot be true simultaneously if you accept that CTA buying of $45 billion will produce additional price appreciation. The contradiction between Goldman's macro advice to its hedge fund clients and Goldman's systematic positioning data is not an accident. It reflects the specific tension between a bank whose hedge fund clients are screaming because they are short, and a bank whose systematic positioning data is mechanically telling the market to keep going higher. The options market data from this week makes the hedge fund situation even more structurally difficult. Total call option volume on the S&P 500 hit a 2026 high just days ago, according to the data cited in the source material for this analysis. When call option volume spikes to record levels, the most common explanation is that participants who cannot easily exit short positions through the futures or equity markets are buying call options as a synthetic way to reduce their net short exposure. They cannot get out through the front door because every time they try to cover their shorts in size, the market moves up and makes the cover more expensive. So they buy calls, which gives them upside exposure that partially offsets the short pain without requiring them to physically buy the index in a way that would immediately show up in market impact. But when a large number of institutions are simultaneously buying calls, the dealer gamma impact of all those call sales produces the same buying into up moves dynamic that amplifies the rally further. The hedge funds, trying to reduce their pain, are inadvertently adding more fuel to the fire. Here is where the chart structure becomes the specific piece of this story that the positioning data confirms. Peter Brandt, one of the most respected technical analysts in professional trading, identified a specific pattern in the S&P 500 that has high historical reliability as a setup for violent upside moves. The pattern is called a head and shoulders failure. The standard head and shoulders pattern, which Brandt tracks, is formed by a left shoulder, a head, and a right shoulder with a neckline below them. Under normal conditions, when the neckline breaks to the downside, it signals a significant decline or even the beginning of a bear market. The pattern completion to the downside has historically been associated with major market tops. What Brandt documents and what makes the current setup so powerful from a technical standpoint is what happens when the head and shoulders pattern fails to complete. When the neckline breaks down, every technically oriented trader and every systematic program that monitors chart patterns begins positioning for the expected decline. Short positions are added, protective puts are bought, bearish bets accumulate around what looks like a textbook pattern completing to the downside, and then the pattern reverses. Instead of following through to the downside, the price recovers above the right shoulder, then above the head. And when it breaks above those levels, every participant who positioned for the textbook breakdown is now trapped in a loss and must reverse course. The forced reversal of all those bearish positions creates the fuel for a move that can be significantly more powerful than even the underlying fundamental case would suggest, because it includes not just buyers who want to be long, but buyers who have to be long because they were wrong on the short side. The S&P 500's move from its panic lows in late March through its 7,000 breach on April 15th has the structural characteristics of exactly this pattern. The market had been forming what many analysts and institutional strategists described as a topping formation through late December 2025 and into February 2026 as the Iran war deteriorated market confidence. The head and shoulder structure was visible, institutional money positioned for the breakdown. The breakdown began, and then it reversed, with the catalyst being ceasefire news and geopolitical de-escalation that squeezed every short position simultaneously. The move above 7,000 is not the completion of a recovery. Based on the Brandt framework applied to the current chart, it is the beginning of the acceleration phase that follows pattern failure. The historically measured target when a head and shoulders failure completes, using the distance from the head to the neckline as the projection, points to a level that many analysts currently consider impossibly optimistic. It is a target that the positioning data suggests is achievable, specifically because the same funds that built the shorts that created the pattern are the ones who will be forced to cover and then eventually chase the upside. The economic data this week provided the specific confirmation that the market's mechanical move is not running into a fundamental wall that will stop it. The Philly Fed Manufacturing Survey released on April 16th showed new orders up across the board. Shipments increased. Unfilled orders declined, meaning factories are working through their backlogs efficiently. Manufacturers trimmed their headcounts modestly, but gave remaining workers more hours, supporting household spending power. The New York Fed Empire State Manufacturing Survey showed expansion and positive new orders. Initial jobless claims came in lower than expected. The labor market is not breaking down. And the Federal Reserve, as represented by Williams Public Communications this week, has made explicit that given all the different things that keep changing day to day and week to week, it does not make sense to try to give strong forward guidance, which is the most important three-sentence message the central bank could send to equity markets. Not raising rates. Effectively paralyzed in the face of the geopolitical uncertainty created by the Iran conflict. And therefore, not the specific threat that would normally stop a momentum-driven equity rally from continuing to run. The inflation picture, which many analysts believed would be the kill switch for this rally, has not yet produced the data that would force Fed action. Energy prices are up from the Hormuz disruption, but the underlying core inflation indicators for goods other than energy have been more subdued than feared. The market has made a specific calculation this week that it is pricing through the energy shock as temporary, choosing instead to anchor on the earnings and productivity story that drove the market to its January all-time highs in the first place. Whether that calculation is correct over the medium term is a separate question. What matters for the current price action is that the market has made the calculation and the mechanical forces of positioning, dealer gamma, CTA flows, tax season capital, and corporate buybacks are all reinforcing it simultaneously. Now let us talk about what the carry trade dimension adds to this picture, because it is the specific tailwind that has received the least coverage and that is contributing to the global buying of American equities in ways that most domestic investors do not see. A carry trade in the foreign exchange market works by borrowing money in a currency with a low interest rate and using those borrowed funds to purchase assets in a currency or market with a higher return. When this trade is working, every participant who runs the strategy is simultaneously a buyer of whatever the high-yielding destination asset is. In the current environment, with American equity markets producing returns that significantly exceed the cost of borrowing in Japanese yen or Swiss francs, the carry trade is pointing equity-seeking capital at the United States market, in volumes that foreign exchange strategists are now describing as at record high levels of profitability. Bloomberg data from this week confirmed that a gauge of returns on such carry trades, where investors borrow low-yielding currencies to invest in higher-yielding ones, is now at record highs. Every day the carry trade produces positive returns is a day that creates additional demand for American equities from international investors who are not making a fundamental bet on the market, but are systematically harvesting the interest rate differential between what they borrow and what they earn. The specific risk in this picture is not that the fundamental case is wrong. The specific risk is that this kind of mechanically driven rally, powered by short covering, CTA threshold crossing, dealer gamma amplification, carry trade flows, tax season capital, and corporate buybacks converging simultaneously, is by definition a borrowed momentum move rather than a conviction-driven accumulation. The Benzinga analysis summarized this risk precisely. Short covering rallies can be notoriously sharp, especially in crowded markets, yet they are not the same as conviction buying. Once the shorts get covered, the source of demand fades. Price movement does not necessarily tell investors much about earnings durability, economic momentum, or whether risk appetite has genuinely broadened. The question that the full picture of data raises is not whether the move can continue. The data says it can. The CTA positioning at the 31st percentile says the machine buyers are only a fraction of the way through their normal buying range. The gamma flip says dealers are going to amplify every up move. The corporate buyback window reopening says there's a $1.1 trillion bid about to re-enter the market. The tax season capital deployment says additional retail and institutional flows are coming in a 10 to 14 day window. The carry trade says international capital is being systematically directed at American equities. All of those forces are real. All of them are measurable. All of them are current. The question is something different. The question is whether the market is headed for the kind of move that you want to be fully invested through, or the kind of move that you want to rent for a defined period, and then exit before the mechanical forces that drove it become the mechanical forces that reverse it. Because every one of the 5 forces just described is also perfectly reversible under the right conditions. CTA funds sell as mechanically as they buy when price crosses their downside triggers. Dealer gamma flips from amplifying up moves to amplifying down moves when positioning changes. Corporate buyback flows stop when earnings season blackouts return and when management confidence in the economic outlook deteriorates. Carry trades unwind catastrophically when volatility spikes because the borrowed capital that funds them is cheap, specifically because it is borrowed against a low volatility assumption. And when volatility returns, the cost of the carry and the risk of the position both increase simultaneously in ways that force liquidation. The current setup is the most important single financial positioning story of the first half of 2026, because the same mechanics that have produced nearly $6 trillion of market capitalization gain since March 30th are the mechanics that will eventually reverse with equal or greater velocity when their inputs change. The pain trade is up right now. The institutional money that is in pain is the money that is short. And the forces amplifying the squeeze of those short positions are real, measurable, and currently pointing in one direction. But the pain trade is just beginning in the sense that the 60% of CTA buying capacity that has not yet been deployed has not yet created its price impact. The corporate buyback resumption has not yet occurred. The tax season capital flows have not yet fully arrived. The short vol trade is being built in a size that will eventually create its own systemic risk. And the carry trade is at record profitability levels that historically precede the kind of rapid unwinding that produces some of the most violent single-day market moves in history. This is not a situation where the correct response is to be entirely out of the market or entirely in it. This is a situation where understanding the specific mechanical forces at work and their predictable limits is the difference between being the one who captures the move and being the one who is still celebrating the move when the forces that created it start running in reverse. The pain trade is just beginning, but every trade that is just beginning also has a point where it is just ending. The difference between capturing the beginning and surviving the ending is knowing which forces you are riding and what makes them stop. The hedge funds that are short are in pain right now. The retail investors who sold into every up move through March and early April are watching the market surpass the levels where they sold and experiencing a different kind of pain. The carry trade players are printing money right now, but sitting on a position whose entire profitability depends on volatility remaining low. The CTA funds are buying because their models say to buy and will sell because their models say to sell when the triggers reverse. And the options market is amplifying every move in whatever direction the current positioning structure points. Right now, that direction is up. The pain trade is up. And by every positioning measure available, from Goldman's prime brokerage data to the Kabisi letters short exposure analysis to the Benzinga CTA flow analysis to the gamma flip documentation in the Alt-Richter weekly report, the move has further to go than most participants currently positioned on the wrong side believe it does. The question is not whether the pain trade continues. The data says it does. The question is whether you are positioned to capture it and whether you understand the specific point at which the forces that make it a pain trade for the shorts will have finished their work and begun creating a new pain trade for whoever chased the top. That answer depends on watching 4 specific things in the coming days. CTA positioning data as it moves from the 31st percentile toward its historical upper ranges. Gamma levels as they either hold positive and continue amplifying upside or flip back to negative if a macro shock produces a volatility spike. The VIX trend as it either continues compressing toward historical low levels or shows signs of regime change back toward fear. And the corporate buyback announcement flow as companies exit their earnings, blackout windows, and begin putting $1.1 trillion of programmatic equity demand back into the market. When all 4 of those signals are pointing in the same direction simultaneously, as they are right now pointing up, the momentum is real, the forces are real, and the pain being felt by the institutional money on the wrong side is real. The pain trade is just beginning. And whether the beginning eventually becomes the middle or the end depends on whether you are watching the specific forces that drove it or only watching the price. The S&P 500 added $6 trillion in market capitalization in 3 weeks. The hedge funds who are paid to predict the market are in pain. The machines are only 30% through their normal buying range. The corporate buyers are about to come back, and the VIX is at 17.48 with short sellers betting it goes lower still. That is the setup. That is the pain trade. And right now, the only people who are winning are the ones who understood that the machine-driven market does not care about your macro thesis. It cares about your price level. And the price level says the pain trade is just beginning.